Hello everyone, I am Tolu no, and my today is our first video of Tax Talks. Tax Talks, right? It's a pun on my business name, and today's our very first episode of real estate taxes. So, if you're a real estate investor, if you're a real estate flipper, that means your work is capital intensive, which also means that you have an incentive to make sure that you save as much cash as possible. And one of those ways is to what? To save on your taxes, because if you have less taxes, you have less cash to keep out, to pay out to the IRS, which means you have more money for your business. Okay, so our topic is gonna be about how to help you keep more of your money, right? And so as you if you're in if you're a flipper, you are used to it. You are, if you're a flipper, you're having to turn property a lot, which means you have a lot of holding costs. But if you are a landlord or a renter, that means that you have to deal with depreciation a lot, right? Now if you're also a landlord, you also have to deal with if you're a landlord, you also have to deal with, depreciation, and depreciation cost, the depreciation cost losses on your taxes. And because you're a landlord, your business is actually inherently passive income, which means the IRS doesn't allow you to deduct those losses right away. You have to carry it over until you have income, until you have net income. And the reason you got into one of the reasons I'm sure you got into real estate is because it has the benefit of having the losses. It is the benefit of having the losses so that you can keep all your cash without actually having to pay taxes on it. Which means that because of the depreciation, you actually have what they call a book income but a tax loss. Does that make sense? Your business is generating you money, generating you cash, it's generating your income, net income. But because you're depreciating it, you're generating losses. And I actually also want to clarify that the losses that you're generating because of depreciation, it's not because you're cheating the government. It's because you bought an asset, like let's say a business asset that you put money into that is going to generate business. That inherently makes it a business expense. But because it is an asset that lasts more than 1 year, you are having to take those expenses year after year after year instead of all at once. So you're actually in the you know you're actually in the you're actually disadvantaged by having to depreciate as opposed to by having to by taking your expense one all at once, right? I mean, of course there are arguments to be made about you know when you generate income, etc., right? But the nitty gritty of that is exactly because of you generating the income. You generate it because of the asset, because it is a business asset that generates you income. That one of the reasoning for the depreciation is exactly because it gives you, it makes you money year after year, right? So you can't just expense all of it all at once. So you're trying to net together the income it's making you. You're trying to net together the income it's making you with the expense that is generated, that it really is, right? So that you don't have all the expense on the back end and then all the income on the front end, right? So that's kind of the mentality with the depreciation as well, right? But in the tax world, it actually has real, consequences of you having to pay taxes on something that you might not necessarily, that you should have been able to just expense all of it right away. So So in 1 year, if you make, let's say, 50,000 and you're able to only get $20,000 in depreciation for your house, well, if you could expense all that 50,000 from your house, because your house is worth, the property is $200,000, but wouldn't it make sense for you to just be able to expense the entire $50,000 so that you don't have to pay any taxes, right? And then do the same thing next year, right? But that's how it has the real life consequence of making you actually have to pay taxes that you really should not have to be. So then your job would be how to maximize that despite all the rules, right? All the rules that are basically, making it so that you have to pay taxes on something that you really should be expensing fully, right? So one of those ways really is to be a real estate professional, to be classified as a real estate professional, because as I was saying, as a landlord, rental business is inherently passive. Why? Because you do not have to work every day to make that money. You get a tenant in there, you put them in there, you have to maintain it every so often, but the money is going to come in anyway. Does that make sense? The money is going to come in on auto as long as you have a tenant in there, right? That's why it's called passive income. As opposed to when you're a flipper, you constantly have to be looking for the next one. You constantly have to be looking for the next property, etc., right? So being a flipper is the actual work that you're doing. So that means that the IRS, they're saying that your rental business is passive, and because it's passive, they don't allow you to take all the losses that you generate in 1 year all at once until you have more passive income to eat up those losses, so that they're trying to net your income with your losses. They're trying to net the income that you have, the passive income that you have, with the net passive losses that you have. That means that if you're as a real because you depreciate because of how depreciation works, that you're expensing that it's trying to match your income with your expenses, right? But then at the bottom line, the IRS is now trying to match your losses with your income. You can see how that can disadvantage you, because when you get into the 1 year where you don't have enough income to eat up the depreciation, you will have a loss, which actually should be every year, unless you're losing money on your property, which should be every year. Why? Because real estate is a big expense. Because real estate is a big expense, right? So that means every year you're generating losses, and now IRS wants to limit it. So when then are you going to have enough passive income to eat up those losses? Good knows 10 years, right? 10 years. Or you have to sell the property. So you have enough passive income to eat up the passive losses, or you sell the property, then you can deduct all the passive losses all at once, right? But of course you don't want to be paying taxes every year for 10 years until you sell your property, right? Or until you generate enough income. You don't want to be paying taxes for all those years. You want to save the taxes now. You want to save the taxes next year. You want to save the taxes, the year after that, right? So what do? You get yourself classified as a real estate professional. And as a real estate professional, because a real estate professional means exactly, the flipper. They're saying that the flipper, because the flipper is having to work for it, right? And it's actually because the flipper is having to work for it, it's actually like a real estate agent. A real estate agent is someone who is in the business of buying and selling property for their clients, right? So they do not really actually buy property for themselves, right? So they're having to do it again and again and again and again and again. It's not that you do it one time and then the income comes. You have to keep doing it. You have to keep finding new clients. You have to keep finding new properties. So that's the same thing a flipper is doing. So that's why those guys are classified as real estate as real estate professionals, right? So their job is active. Their job is active. So because they're active, they're not limited to having losses. they're not limited to having income to cover their losses, right? Because they're just a regular business. Because a regular business has to continuously find new clients, find new customers, right? So they cannot limit their losses like that. So that's how you that's how you get around the loss, the passive loss limitations, is you get yourself classified as a real estate professional. Now, the IRS's definition of a real estate professional, yes, it kind of does. It's trying to mimic what the real estate, you know, flippers as well as the real estate agents are doing, but that's not their actual technical definition in the Internal Revenue Code. Their definition is you have to meet certain hourly requirements in order for you to be qualified as a real estate professional. So they're actually making it easier for you to be classified as a real estate professional. So you don't actually have to be a real estate agent. You don't actually have to be a flipper. Although the way they do it, yes, you do have to end up being somebody who flips houses so many times a year, right? But you don't have to be someone who always flips houses. Does that make sense? So they've actually made that easy for you. It's like they're trying to screw with your mind. They want to make it difficult for you to deduct expenses, but they make it easy for you to deduct expenses, right? So who knows what they're trying to do with all those rules, because they're not clear to me, and I read the Internal Revenue Code for breakfast. So now, so the definition. So so you have to meet two requirements to be a real estate professional. You have to be one. You have to work at least 750. Excuse me. You have to work over 750 hours in in flipping property a year. So you have to work over, not just you have to work an amount that is equal to 750 hours, but it has to be over that. So it has to be 751 at least, right? 751 hours, right? If you have that, then you have to say, out of that 751 hours, if I have another business, what is what is the split? What is, if I have another business that is not in real estate, that is not a real estate rental business or another passive business, how many hours am I spending in that? And if that is higher, and if that is over is less, that if that amount is less than the same amount of the 751 hours, it has to be less, right? It has to be less than the 751 hours. So you have to spend 751 hours in the flipping business, in the real estate trading business, right? But you have to spend less than that in another active business, right? So if you have no other business, then yes, you would qualify as a real estate professional if you're spending 751 hours, right? But if you have another active business, then you might not. Then you have to see how many hours do I work in that, and if that is about the same, you don't qualify. And if that is less, then you qualify. And if it's more, then you don't qualify. So basically, you have to work more than half of your flipping business in your total active businesses. So your flipping business, the hours that you put into your flipping business has to be more than half of your entire active businesses. Whew, isn't that crazy? So if you meet those two criterias, right, then you can be classified as a real estate professional.